So before he was the Warren Buffett, the investing legend, just picture this. A young kid delivering 500 newspapers every single morning before dawn.
Right. And that wasn't just, a simple paper route. It was this complex logistical thing he figured out daily.
Exactly. And it kind of points to something deeper about him, right? This lifelong thing about solving problems, whether they're huge or pretty small.
That's precisely what we're digging into today. It's easy to focus just on the investing genius.
The Oracle of Omaha stuff.
Yeah, but we're looking at Warren Buffett, the problem solver.
And we've sort of mapped it out across his career.
We have. We've looked at 7 key phases. And for each one, we're trying to nail down what was the problem, how did he tackle it, what were the signs, what were the payoffs, and maybe most importantly for you listening, what are the lessons you can actually use?
Like a shortcut to thinking more effectively based on his journey.
Exactly. Distilled from, one of the most successful people out there.
Okay, so let's start way back. Those early days. The problem wasn't just, I need pocket money. It was deeper, like a real drive to build wealth his own way.
Yes, and what's fascinating is how young he was when he started spotting these really simple, everyday needs. Things people wanted.
Like selling chewing gum or Coke door to door, magazines too.
Right. It wasn't complicated market analysis. It was
Yeah.
just seeing, okay, people want this, and maybe it's not super easy for them to get it right now.
Then acting on it, not just seeing the gap, but going out there door to door.
Absolutely. Initiative. And he was incredibly resourceful, wasn't he? Figuring out the logistics, managing his little inventory.
Managing the money he made, he wasn't just spending it.
That's crucial. He was already thinking about what to do with the earnings.
Which brings us to that pinball machine story. Putting one in a barber shop. That's not just selling something once. That's like creating a tiny ongoing business.
A little passive income stream. So the benefits early on were pretty clear.
Yeah.
He saved up some capital, got that hands-on business experience.
Learn to rely on himself.
Definitely. But like you hinted at with the 500 papers, it couldn't have been all easy, right? There must have been challenges.
For sure. Other kids doing similar things, managing the routes, keeping track of it all.
Exactly. Even at that small scale, he was dealing with competition, operations, finance basics. The lessons there for anyone starting something are just so fundamental.
Start small, figure it out as you go.
Learn by doing, spot those simple needs people have. And yeah, that point about reinvesting the profits early, that's where the seed of his whole compounding philosophy really started, you could argue.
Okay, so let's fast forward. The problem changes. Now it's about consistently beating the stock market. That's a whole different beast.
A very different beast, yes. And his problem-solving methods shifted dramatically.
How so? What did that look like?
Well, you see this move towards just intense analytical work, really deep reading of financial reports, Moody's manuals, S&P guides.
Not just skimming.
Oh, no, it was like a forensic analysis, trying to truly understand the business behind the stock ticker, making decisions based on data, on fundamentals.
Which is how he got tagged as an analytical machine, right?
Precisely. And the benefit, well, consistently outperforming the market over the long haul, making rational calls when everyone else was, chasing fads or panicking. That built his reputation.
The Oracle reputation.
That's the one.
And that core idea of value investing, finding good businesses, selling for less than they're worth, that comes directly from this deep dive research.
Absolutely.
What?
But, as you know, the market isn't always rational. What about dealing with that? The hype, the fear, valuing really complex companies?
Yeah, how did his problem solving handle that?
That's where his discipline really shines.
Yeah.
He acknowledged market irrationality, but he didn't let it dictate his actions. He built this solid framework, his principles.
And stuck to them.
Rigorously. And for complex businesses, he often simplified, focused on what he could understand, what he later called his circle of competence.
Right. Stick to what you know.
Exactly. The lesson there for anyone running anything is huge. Really know your industry, base your big calls on data, not just gut feelings, and build your own solid framework to guide you through the noise.
Okay, let's pivot to Berkshire Hathaway itself, the original company. A textile mill in a dying industry. That's a massive problem right there.
A huge strategic challenge. And what's really striking is his honesty about it. He didn't, pretend it was going to turn around. He saw the writing on the wall.
He faced the tough reality.
He did. And the key sign of his problem solving was deciding where the money should go next. Strategic reallocation of capital, that's the term.
So instead of throwing good money after bad in textiles,
He started using the cash flow from textiles, paradoxically, to buy into completely different businesses. Insurance, other things, making strategic acquisitions.
Which totally transformed Berkshire.
Totally. Into the diversified holding company it is today.
Yeah.
The benefits were just immense, unlocking huge value, massive growth, building something resilient.
Using the cash from the dying business to fund the new life. It sounds pragmatic, but managing that decline, finding the right new places to invest, dealing with the old legacy, that must have been tricky.
Oh, incredibly tricky. Took real vision and, frankly, some tough decisions to eventually wind down the textile side.
But the lesson is powerful.
Very. Don't let nostalgia or sunk costs keep you tied to a declining core business. Be willing to pivot, move resources smartly, and see that kind of transformation as, well, a path to growth, not failure.
So as Berkshire grew and Buffett became more famous, he faced a different kind of problem. How do you talk about complicated financial stuff in a way people actually understand?
Yeah, communicating effectively amidst all the jargon and complexity. His approach here is, again, quite distinctive.
But what are the signs?
Just look at his writing and speaking. He uses plain English. He's remarkably transparent, very candid. He even talks openly about his mistakes.
Which is rare in that world.
Extremely rare. And the benefit was building this incredible trust with shareholders, with the public. He wasn't just reporting numbers. He was educating people, demystifying finance.
Those annual shareholder letters are legendary for that reason, and the marathon Q&A sessions at the meetings.
Exactly. Those aren't accidents. They're deliberate choices to communicate clearly, to make complex things accessible.
It would have been easy to hide behind jargon, though, and surely finance is complex. How did he make dry topics engaging? And, wasn't there pressure to maybe spin things a little when the news wasn't great?
Well, he uses analogies, humor, a very down-to-earth tone. He tells stories, and that transparency about mistakes, that actually boosts his credibility. It shows he's giving you the straight story, not just hype.
So honesty pays off.
In the long run, absolutely. The lesson is crystal clear. Talk straight with everyone, your investors, your employees, your customers. Be honest, especially about challenges. Admit when you mess up. It builds rock-solid trust.
Okay, shifting gears again. Financial crises. When the whole system seems to be melting down, that's a problem on a massive scale. How has Buffett handled those periods?
His approach during crises is really revealing. It shows incredible emotional control and that long-term perspective again.
Signs of problem solving there.
Staying calm when others panic. Sticking to his discipline, his risk framework, and, crucially, being willing, even eager, to put capital to work when fear is rampant.
Being greedy when others are fearful, as he famously said.
That's the essence of it. It's a counter-cyclical strategy. And the benefits, often significant returns on those crisis-era investments. Plus, he provided stability, confidence just by stepping in.
Like those big investments in Goldman Sachs or GE back in 2008.
Prime examples, he was essentially providing capital and a vote of confidence when few others would.
But investing huge sums when everything feels like it's collapsing, that takes nerve. How does he spot real value in the chaos and manage that enormous risk?
It comes back to fundamentals and that circle of competence. He invests in businesses he understands, whose long-term value he feels confident about, even if the market price is temporarily crushed.
So it's not just bravery, it's calculated confidence based on deep analysis.
Exactly.
Yeah.
And his emotional discipline lets him ignore the noise and focus on that long-term value. The lesson is powerful. Develop that emotional control, maybe keep some powder dry so you can act when opportunities arise in downturns.
And always focus on the underlying value, not the market's mood swings.
Precisely. Long-term value over short-term panic.
Okay, let's talk about a core challenge for any big business.
Right.
Capital allocation. Deciding where to put the money. What's Buffett's unique angle here?
This is where insurance float becomes so important to the Berkshire story. It's a key part of his problem-solving around funding growth.
Explain float again, simply.
Sure, insurance companies collect premiums up front, but they only pay out claims later. That pool of money they hold in the meantime, that's the float.
Money they hold but don't technically own yet?
Right. And Buffett realized this float was like a huge, very low-cost loan he could use to invest elsewhere. So buying great insurance companies like Geico wasn't just about selling insurance.
It was about getting access to that float.
Exactly. It was a strategic way to secure stable, inexpensive funding for all of Berkshire's other investments. It's been a massive engine for their compounding success.
So manage the insurance side well, and you get this river of cheap capital to fuel everything else. Genius. But insurance has its own risks, right? Underwriting, regulations, and then you have so much float. Finding enough smart places to invest, it must be hard.
Oh, absolutely. Managing underwriting risk so you don't lose money on the insurance itself is critical. And yes, navigating regulations is complex. Deploying billions effectively is a constant challenge.
But the underlying principle.
The lesson is vital. Look for stable, low-cost funding sources. Think about how your business structure can give you financial advantages. And realize that deciding where capital goes, that's not just a finance job, it's maybe the core job of a leader.
Okay, final phase. The problem of legacy, of succession. What happens next? How has he approached planning for the future of his fortune and the leadership of Berkshire?
This really shows his long-term thinking and sense of responsibility. You see it in a few key ways.
Like what?
Well, first, pledging the vast majority of his wealth to philanthropy. That's a huge decision about legacy. Second, picking trusted people, like the Gates Foundation, to handle that giving effectively. And third, the very deliberate process of identifying and preparing successors within Berkshire.
Making sure the company continues smoothly after he's gone.
Right. It's about ensuring the wealth benefits society, and that the company he built endures with strong leadership.
That massive gift to the Gates Foundation really sent a message, and bringing in investment managers like Todd Combs and Ted Weschler years ago seems like a clear part of that succession planning.
Exactly. Integrating them, giving them responsibility, preparing the ground. But, managing the distribution of that kind of wealth, finding leaders with the right skills and integrity, dealing with all the public attention. These are not simple problems.
So easy answers there.
None at all. But his approach offers lessons for anyone thinking long-term. Plan for the future of your business and assets early on. Identify and mentor potential successors. And think about the impact you want to leave behind. Beyond just the financial results, it's about building something that lasts.
So if we step back and look at all these different problems, these 7 phases, is there a common thread? What's the essence of Buffett's problem solving?
I think it really comes down to a few core things. Clear, rational thinking consistently. Discipline sticking to his principles, even when it's hard. And always that long-term view.
From selling gum to navigating global crises.
The principles stay remarkably consistent.
It's an amazing journey to track. And it makes you think, doesn't it, about that connection between this kind of problem solving and his idea of the circle of competence. I mean, how does focusing on problems you genuinely understand make the solutions better, maybe less risky? It feels like staying in his lane, so to speak, has been crucial all along.
It certainly seems that way, a very interesting point to ponder.
Definitely something for you, the listener, to think about in your own world, because understanding these principles, seeing how they work across different situations, it really does offer insights into solving problems more effectively, whatever field you're in. It's like a shortcut to being, well, a bit more informed and maybe a bit more effective yourself. So before he was the Warren Buffett, the investing legend, just picture this. A young kid delivering 500 newspapers every single morning before dawn.
Right. And that wasn't just, a simple paper route. It was this complex logistical thing he figured out daily.
Exactly. And it kind of points to something deeper about him, right? This lifelong thing about solving problems, whether they're huge or pretty small.
That's precisely what we're digging into today. It's easy to focus just on the investing genius.
The Oracle of Omaha stuff.
Yeah, but we're looking at Warren Buffett, the problem solver.
And we've sort of mapped it out across his career.
We have. We've looked at 7 key phases. And for each one, we're trying to nail down what was the problem, how did he tackle it, what were the signs, what were the payoffs, and maybe most importantly for you listening, what are the lessons you can actually use?
Like a shortcut to thinking more effectively based on his journey.
Exactly. Distilled from, one of the most successful people out there.
Okay, so let's start way back. Those early days. The problem wasn't just, I need pocket money. It was deeper, like a real drive to build wealth his own way.
Yes, and what's fascinating is how young he was when he started spotting these really simple, everyday needs. Things people wanted.
Like selling chewing gum or Coke door to door, magazines too.
Right. It wasn't complicated market analysis. It was just seeing, okay, people want this, and maybe it's not super easy for them to get it right now.
Then acting on it, not just seeing the gap, but going out there door to door.
Absolutely. Initiative. And he was incredibly resourceful, wasn't he? Figuring out the logistics, managing his little inventory.
Managing the money he made. He wasn't just spending it.
That's crucial. He was already thinking about what to do with the earnings.
Which brings us to that pinball machine story. Putting one in a barber shop. That's not just selling something once. That's like creating a tiny ongoing
A
business.
little passive income stream. So the benefits early on were pretty clear.
Yeah.